Banks are turning up the heat on high growth funds. How Milford's boss plans to curb the new competition.
More competition, fantastic. But the biggest thing is we want nobody defaulting to Milford. People get too caught up today. Sure, 6% might be the risk rate return today, but we're talking about investing people's money over 10, 20, 30 years. Going out to 2030, I still feel there will be good returns. Whether they will be of the same magnitude as we've seen in the wonderful last 10 years, maybe not.
It's Friday, the 1st of December, and you're watching Markets with Madison. In the past week, banks ASB and BNZ have both launched high growth funds for investors, with a near 100% allocation to assets like international equities. Investors are increasingly chasing more aggressive strategies, as the data shows it does pay off longer term. But with more demand comes pressure on fees, and fund managers are having to work harder to beat the return on money in the bank. Milford Asset Management is one of the largest active fund managers in the game down under. I sat down with its chief executive this week to find out how he plans to curb his new competition. Well, Mark, it's good to see you. Thanks so much for doing this.
No, welcome. Yeah.
Let's talk about first the heat on high growth. In the past week, we've seen ASB and BNZ both launch aggressive high growth funds for their investors. Why do you think investors are getting more aggressive and these funds are seeing an opportunity within it?
Well, certainly from my viewpoint, competition's fantastic. So, we've had a long-standing aggressive fund in the marketplace really for the last 3 years. And I think it's probably less around investors wanting to take more risk. I think it's investors having a better understanding of their investment timeframes. And this is really coming out of KiwiSaver. So you're investing for the long run. You're looking at 20, you're looking at 30, 35 years. So if you're investing long run, you can take more risk. And therefore, you're seeing funds coming on that are taking more risk. So they've got a 90, 95, even 100% weighting to it. So I think it's coming around from that kind of long-term investing retirement focus.
And how's Milford going to fight for funds under management in that more competitive context?
Well, we think that we're there already. So again, more competition, fantastic. We think we've got a great product with the aggressive fund that could suit a number of people. But I think also people have got to not get too caught in a kind of a trend. So if you have a look, we've got a great aggressive fund that's performing in one of the best in its category. But if you compare its return over the last year compared to active growth has got a better return. So people have just got to be aware that you're not just jumping onto the latest bandwagon. Really understand what you want, understand what it's doing. And for those types of funds, you've got to stay in there over the long run. You can still see the 70-30, or the way we run it with an absolute return type style can still do incredibly well going forward.
What are you thinking going forward about those growth assets? It's largely equities that these funds are playing in.
Yep.
What are you thinking about if we talk about that trend? I mean, the Magnificent Seven has been amazing for that part of the market, but more people are moving in. But can we expect that to continue?
I think certainly over the next, say, 7 years going out to 2030, I still feel there will be good returns. Whether they will be of the same magnitude as we've seen in the wonderful last 10 years, maybe not. But I think there's still good returns to get. And I guess from our viewpoint being active, we still see, regardless of the kind of headline returns, some great opportunities for us to take advantage of. And even if you're jumping, quickly to fixed income. So people talk a lot about equity. Fixed income, you could see the best returns from fixed income in the last 20 years. So you could see in the next 18 months to 2 years, returns that match equity style returns. So again, having funds that are potentially diversified, that can move around and take different opportunities, can give you some great outcomes. So if we see a fairly benign equity market for the next 12 months, but you're in a diversified fund, like active growth or like a balanced fund, that can pivot to fixed income and credit and take advantage of that, that could support your returns over the next 12 to 18 months.
But they're not exactly growth assets or aggressive assets, are they? Fixed income?
No, they are, but it's actually pivoting to take advantage of some of those more short to medium term trends. So if you can get an equity type return without the risk, why wouldn't you take it? So we're kind of set up to be active and to go where we see the best risk return. So we're not boilerplated around going, well, we're stuck on 95 and that's what you're going to get. We can say, look, if we don't like equities right now, or maybe in the next 6 months to 12 months, we can pull that back and we can dial up credit. And then if we feel credit's had a good run, we can move things around.
Well, let's talk about that risk-free rate of return, because it is getting harder to beat. You can get, in New Zealand at the moment, minimum 6% on your money in the bank in 12 months, which is pretty damn good. So how are you having to, or how are you thinking about having to fight that bigger barrier to people get their money out of the bank and give it to people like you?
So right now that's challenging. So if you sit at the bank and you're earning that type of rate, you can understand why people may stay. But again, it's looking at a client and saying, what are you looking to try to achieve over that medium long run? So what's your investing time horizon? Is it 10 years plus? What's your attitude to risk? Are you prepared to take some more risk? And therefore not get too caught up in the short term. So all of our funds have got, I think, a minimum of 3-year time horizon. So people get too caught up today. Sure, 6% might be the risk rate return today, but we're talking about investing people's money over 10, 20, 30 years. So make your decision based off that. So if you look right now, I mean, we just had this incredible early Santa Claus rally. So, some of our funds are up 7% in November. So again, if you've got people, again, sitting there making these short-term decisions, you're missing out on, some pretty big opportunities. So again, it's the client saying, what am I looking for? What's my investment time horizon? What's my attitude to risk? Thinking about that and making those medium, long-term decisions. And you won't regret that. But it's people trying to do all these little short-term games, get into trouble.
What else do you view as potential risks to that active investing adoption and mindset?
I think it's around, for us, playing our own kind of game. So we're very confident around what we do. So there is kind of pressure on fees. We're not kind of naive to that. As we grow, we will certainly share our scale with our investors. But what we're doing is, the way we're showing it at the moment, is improving our proposition. So if you're a business where you've got scale and your only option is to cut your fees, then I think you're devoid of kind of ideas and opportunities. So what we're doing is, we get great scale. We're saying, right, we can lead on digital advice. We can lead on human advice. We can lead on the information that we supply our investors. We can build a great portal. We can build a great app. We can run great live streams. So we're actually saying we want to be a world-class investor, and our clients really value that total proposition. So they want to get that kind of trust. And we were talking just before we got going around, say, ChatGPT. Well, if you put something into that and you get an answer, what if you don't like it? What if you don't understand it? Can you phone anyone up? No, you can't. So we're here to say, well, we are a business where, yes, you may be able to deal with us in a digital way, but we got people behind it that can really, really help. So we're looking at that total proposition. Great active, great risk return that we can get for our clients, but at the same time, superb service, superb advice, great information, great engagement. And that will keep you on that journey.
You don't foresee AI being a better portfolio picker in just a few years' time?
No, I don't. I think it will definitely help, and I think it will help us get to more information around companies quicker. But in the end, you're still making judgments around the future. So I think it will get us faster to it. It will cut, if you're looking at global equities and you've got 10,000 to pick from, I think it's going to help you narrow things down again. But I still think having that human making that judgment, making some of the calls around how much do I want in growth, how much do I want in fixed income, how much do I want in cash, is very much around a kind of a future call. So I still see active investing being incredibly strong going forward.
How funny that AI could almost stand for active investing. I just figured that out.
Well, it could.
Another acronym, ETFs. There is this shift into more passive. Do you view that as a good thing, that at least more people are getting into the market through ETFs? Or do you view not being in the market as not good enough and you'd rather than be in market beating, potentially, positions?
I think it literally comes down to what you're looking for as an individual. I mean, we believe in active investing. It's people believe in kind of passive, and that's a point of view. We kind of don't agree with that, but it's just great competition. So if I look at, certainly in New Zealand over the last, 10 years or so, there are what I would call some genuine passive providers that are out there providing passive with passive fees. Whereas probably prior to that, you've got certain providers out there that are still charging some pretty high fees for passive. So I think it depends what you're looking for, depends what you value. So if I look at Milford, we don't want any clients to default to us. So we get lots and lots of questions around why aren't we a default provider, and is it around fees and bits and pieces, and to some extent it might be. But the biggest thing is we want nobody defaulting to Milford. So we want to say, if you want to join Milford, you understand what our proposition is about. You value that. You value a strong
You're willing to
investment
pay
team.
for that.
And
too.
you're willing to pay for that, absolutely. So you understand what the value proposition is, and that's what you're looking for. You like some great advice. You want great service. You want great technology to support your services. If you value that, great. But if you don't value that, then fantastic, but go and find someone else. And so it's just being very strong around what we do.
The latest KiwiSaver Morningstar report shows that the largest amount of pressure on fees is in the high growth, aggressive categories as more investors move into that. It sounds like you're rather trying to justify Milford's fees as opposed to looking to lower them. Would that be a correct assumption?
No, what we're saying is we've got fees that we think is very reasonable, very fair for the all-round package that we deliver. And as we grow, there will be opportunities to move on fees as well as enhance our services. So some of our funds, our fees have altered. We've removed the membership fee on KiwiSaver. So where there are opportunities, we will absolutely make some of those changes. But at the moment, we feel we offer fantastic value for money. We think we've got a great proposition. And the danger is that you can, as a business, you can worry too much around what's going on. So like pressure on fees. Well, fees are lowering because there is a bigger passive percentage. But that doesn't necessarily mean the active managers are kind of lowering. And if you look at going forward, say if returns are going to be maybe a little bit lower than they have been historically, well, if you can generate alpha from that, that's going to be a bigger percentage of that return. So if you look in Australia, if you look at the super funds, they're now moving back to more active because they're saying, in the last 10 years, it was just about beta. If you just give me the market, I'll get a great return. Mm-hmm. The next 10 years could look very, very different. The next 20 years could look very different. We could see more stubborn inflation. So actually investing in someone who's looking to try and get some alpha, looking to try and get some extra return, could be a bigger proportion of your overall return.
Well, let's talk about those future opportunities and offers to investors. Where do you see opportunity for that? We've seen other funds move into things like private company syndication, those sort of not IPO level companies that they're getting into, kind of like private equity, and then selling shares of that in offerings to their customers. Venture capital, we've seen opportunities increase there. What are you thinking about what Milford might offer next?
Well, it's a great question, and it's part of our DNA. I think is to invest into New Zealand Inc. and some private equity opportunities, and we've always done that really from the early stages. It's tends to be a relatively small proportion of our funds, but if we see some really good opportunities, we will look to take that. I think the interesting thing is, reality is, the bigger the KiwiSaver market becomes, the bigger funds become, the more kind of challenging it gets to invest in those types of funds, because you're taking, for it to be meaningful, you're going to have to take a pretty big ownership stake in those organisations. So it's the one thing I think that KiwiSaver has been, to me, has been incredibly successful. The one element that is disappointing is the lack of impact on New Zealand Inc. So if you look at New Zealand equities, it's less than 10% of total KiwiSaver. Now, what's going to need to change to kind of have some of that money flowing back? And at the moment, when you've got pretty tough liquidity rules, you can transfer your KiwiSaver from a bank to Milford in 10 days. So what does that mean? That means those providers have got to manage liquidity really, really well, because that's that kind of scenario that you face with. So what it means is that those opportunities to invest into some of those up-and-coming businesses here are kind of tougher. So one of the things that I think we could look at is saying, do we change some of the portability rules around maybe elements of your KiwiSaver, just as an idea to look at. So you might say, right, you could be allowed to have 20% of your KiwiSaver in an illiquid fund that may be only priced 6 monthly, once a year, and only depends on buy and sell opportunities. So your remaining
like
80, yeah, absolutely. So effectively a limited partnership type setup, but within a KiwiSaver. So it won't suit everybody. Clearly it's people that are more aware. But you're saying, well, if I like that and I want to invest in more private equity over the long run, I've got a 30-year time horizon. Why wouldn't you? And I think the trouble is the private equity at the moment really only suits wealthy people, because they can get in on the various wholesale tests.
And it's not cheap to get in.
And it's not cheap to get in. But you're actually saying it potentially can suit younger people that have got a big time horizon that might like to invest in something. So could you have a proportion, if you wanted, that is actually not portable or may only be portable depending on you managing to sell? But the other 80% could be still portable. So that might mean that there's some opportunities for that flow to, as KiwiSaver grows, for that flow to continue coming back into our market. Because the NZX market, I actually think the quality of New Zealand companies is strong. We think there's really good management teams, really good competitive propositions, a really good strong track record of returns, say even if you're comparing that to the ASX. So that's a massive tick. But your viewers aren't going to fall off their chair on the fact that it's got no depth. It's got low liquidity.
Exactly.
The last, I think, main listing, IPO was back in late 21.
Mm-hmm.
So you're going, how do you stir that up? Especially when you've got a neighbour, a very close neighbour, similar culturally, where their market is 22 times the size of ours. So it's challenging. It's not a kind of an easy solution. But if I look globally, where countries have got strong local markets, it is pinned around a long-term retirement savings scheme. If you take the US, you take the UK, you take Australia, kicked it off in 1992, 2 to 4%, moving to 9.5% in 2001-2. That is completely underpinned their stock market. So we're starting very late, KiwiSaver, very, very late, 2007. It's got off to a great start, but we've just got to make sure as that grows, you could have 200 billion in there by 2030. How do we look at opportunities to make sure that doesn't completely miss NZ Inc? Because at the moment, it is.
Thank you so much.
Yep.
Appreciate your time.
Lovely. Thank you.
Now, I did ask Mark about a possible Bitcoin ETF and if Milford would be keen to jump in. He hasn't quite decided yet. He is sure, though, that Milford doesn't need to buy a fund management firm. There's been quite a bit of consolidation in the industry, with Fisher Funds buying Kiwi Wealth and Forsyth Barr apparently in talks to buy Hobson Wealth Partners. But Mark told me Milford's experiencing enough growth organically, so he doesn't feel the need to buy any more customers. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.